Good morning. We're here to cover DRQ, and we'll start by technical analysis. This is the long-term chart going back to 1996 at the company's IPO. We had this bull run here in 99 and early 2000, then a bear market that lasted until 2004, then a big bull run here until mid 2006 and an all-time high here at $45 or so. Then the stock traded sideways, and now it looks like it is about to break out again to a new all-time high. Let's check the more medium-term chart. Okay, here's the 45.02. That was the all-time high set here in May 2006, and the stock closed exactly there on Thursday. And now, well, the trend says it will break out because that's the long-term trend, and those usually prevail. Let's check the short term. Okay, here we have it. This white candlestick here, it will probably break out. Perhaps not right away. It may still pull back a bit due to this long-term resistance, but over time it will probably break out. That's what the chart says. Now let's check the fundamentals a bit. This is the share count since 97. It was really stable since 97 until 2004 at about 34.5 million shares, but then it jumped to 38.5 in 05 and now 40.4 million shares in 06 and 07. That's the current share count made in February 2007. So considering the base year of 2004, the share count has been increasing at a 5.3% pace here from this 34.6 million to the current 40.4, and the market cap since 2004 has been growing at a 63% average annual pace, compound annual growth rate. So I'll consider as a dilution factor in my model. That's one of the variables of my valuation model, a dilution factor of 5%. Moving on, this is the balance sheet. We have here long-term debt and current ratio. Well, long-term debt has been reduced to almost zero, just $2 million in 06, and the current ratio is quite high here at almost 4, which shows a healthy short-term liquidity picture. I like to see it above 2, so at 4 is really attractive. As for cash and marketable securities, it is growing a lot, 200% a year since 2004. Receivables are also growing, and inventories too. But no, I don't see any problem here with the balance sheet. So that 1.05 dilution factor looks fine to me. Revenues and gross margin. Well, there wasn't much growth here until 04 and 05, then strong growth in 05, 06, and expected for 07 and 08. Revenue compound annual growth rate with a base year of 2004 is 33.8%, and the industry average, but this is just from 2005, that's the data I got, is 33.5, so about average. Gross margin jumped a lot here in 2006 from 36% to 45%. This is really a positive fundamental development, and the industry average is 39.6. As for the price to sales ratio, our company looks more overvalued, not overvalued, how should I say this, highly priced in relative to its sales, because its price to sales ratio is 4.1 and the industry average is just 2.23. I'll consider 1.3 as my variable here. I need the revenue compound annual growth rate for the future, and I'll put 1.3. That's 30% going forward. As for earnings per share and net margin, you can see that there wasn't much profits here, about between 30 and 50 cents until 2005, where we got 90 cents and $2.15 per share in 2006. Net profit margin also jumped a lot from 5.43 in 2004 to 9.4% in 05 and 19.5% in 06. So this is really a positive development. For 07, analysts are expecting 20.8 net profit margin and 21.9 for 08. So I'll consider 21% on my valuation model, and it was 19.5% in 06. Price to earnings ratio 17.3 for DRQ and 17.6 for the industry average, so right in line with the average. Here's my valuation model. So these yellow lines are known facts, the orange lines are calculated automatically by the model, so I just have to fill the white lines. The dilution factor, as we've discussed previously, 1.05. The revenue compound annual growth rate 1.3, means 30% revenue growth going forward. Final net profit margin estimate 21%, and the earnings per share multiple estimate 17.6, which is the current industry average. And this gives me a share price compound annual growth rate expected for the next 3 years of 25.5%, and an optimal selling price of 56.95, and the current price is 45.02. So, well, not terrific, but attractive, because when I consider stock attractive when the share price compound annual growth rate is higher than 16%. So at 25.5, I consider it attractive. When the share price grows and this number drops to below 16, I no longer consider it attractive, and I look for other opportunities. But right now, this is moderately attractive. My rating on a 1 to 10 scale is 8. Thank you. Bye. Where is this?